Hi, everyone, and happy Friday. Welcome to Trader Tales with IBD. I'm your host, Alissa Coram, and joining me on the show this week, we have David Saito-Chung, IBD's Deputy Markets Editor, Hatman Extraordinaire. Good to see you, Dave. Happy Friday.
Happy Friday, Allie. Always good to see you, and thank you for letting me be on the show.
Oh, of course. And usually when we say good to see you, it is virtual, but we actually did see each other in person this week because I'm not in my living room this week, coming to everyone live from Los Angeles. And it was such a fun week and jam-packed with lots to do work-wise, but also a lot of good team building stuff too, which was really fun.
We had staff members coming in from the East Coast and down in the Southwest, and even one staffer who just recently moved from India. So it was a great week to see so many of us here in person on the 29th floor in the Mid Wilshire district in LA. So unforgettable week, and so also unforgettable week for the market probably.
Oh yeah. Oh yeah. If it wasn't just going to be a busy week with all of us together and all of the activities that we planned, we happened to do it on one of the biggest weeks, and it was very pivotal for the market. So let's go there. Just Dave, we're going to talk about some historical charts and some
hmm
really interesting trends that you've researched and uncovered. But first, I just want to get your take on the action this week because it definitely did feel like a shift in the tone.
Completely agree. It felt like institutional asset managers decided to take on a little more risk. And by that, I mean buy some more stocks and also focus on those areas that have been beaten down. And a lot of sectors have been since the end of November. So we're starting to see some serious shifts in the market, more buying in heavier volume, always a good sign if you are a bullish investor.
hmm Okay, so I think we're at a pretty pivotal point, and
hmm
something that has been on many investors' minds, especially this year. We're always hearing about interest rates and rising rates and how that's impacting the market. We've seen the 10-year yield come off a bit, and sort of the timing of the market's recent rally has been with the 10-year yield coming down a little bit. So,
hmm
in general, how important is it, do you think, for investors to be staying on top of what interest rates are doing and how that could have an overall impact on their portfolios and performance and how they should be positioned in the market?
Well, we think that interest rates have an enormous effect on the long-term moves in stocks. Interest rates are a measure of how much does it cost to borrow money to buy equities, and also for corporations to invest in their own stocks. Corporate buybacks are a big part of the stock market, and maybe people don't really see that as much because you don't hear about that in the news. But right now, in the short term, just as you said, Ali, the yield or the interest rate on the benchmark US Treasury 10-year bond has come off significantly from its recent June high around 3.4%, now down to about 2.6%. That makes it much easier for funds to invest in stocks, borrowing money, as well as corporations to continue to borrow and not only invest in their own future, but also invest in their own stock. There's plenty of data showing that stock buybacks over the past decade has contributed enormously to individual investor returns. Now, we're going to look at a monthly chart of the 10-year bond yield based on SIBO data. That's a Chicago Board Options Exchange. Now, the chart that you see right now is a monthly chart, and what you have to do is divide that figure by 10 to get sort of
hmm
a good idea of what the interest rates are. So, looking at 2020 at the sort of the height of the coronavirus market crash, you can see that the Fed was seriously concerned about a possible global depression, and so they bought lots of bonds, and that sent the yield on those bonds all the way down to nearly 0.3%, near zero. The Fed funds rate, which they have total control over, was also down to the 0.25% interest rate level. Since then, you see this dramatic rise in interest rates, which makes it more costly for corporations to buy back stock and for fund managers to also borrow money to invest. So this is, in my view, one reason why stocks have had a tough time this year. It isn't just simply inflation, but really the cost of investing.
Yeah, that's right. So we love looking at historical precedents because history never repeats, but it does rhyme. And there's so much to learn from past periods in the market. And not to say that that's a crystal ball by any means, but it does give us an edge of what potential scenarios to expect. So, Dave, what are you keying off of here from past market cycles that we could really apply to perhaps what we're seeing today? It just, open our eyes in terms of the relationship between these longer term rates and market performance.
Let's go back to that Marcus Smith monthly chart of the SIBO 10-year note. And here again, we're looking at the yields. And I want to highlight two other periods. One, looking at this chart from 2008 to 2012. And you can see, yes, there were fluctuations, big moves up and big moves down, but the general trend of interest rates was down, which meant that the central bank, the U.S. central bank, was encouraging investors to go into stocks, especially after the great financial crisis, right? In 2008, it decimated the mortgage market, and there was really a fear of a systemic crash in the financial system. So they did their best to make sure it was affordable and attractive to invest in equities versus other assets. So the second period that I'd like to highlight is from the end of 2015 to the end of 2018. So December 2015 was in fact the first time in 9.5 years that the Fed actually raised the cost of money, raised the Fed funds rate to simply a 0.25 to 0.5% target range. And by the time that they were finished with this rate hike cycle, the Fed funds went up 200 basis points, or roughly 2 percentage points by December 2018. Over that period, yes, there were some hiccups here and there, but in general, the stock market was pretty good in terms of investing. It was only in the last quarter of 2018 when the Fed signaled that it would continue to raise interest rate hikes. That led to a short but severe reaction in the stock market. There was a bear market, technically. The NASDAQ, the S&P went down more than 20%. Jerome Powell, the head of the Fed in January 2019, did an about face regarding his thinking on interest rates. And 2019 turned out to be a good year for the stock market. So what's the key lesson here, I think, is one, markets can rally even though interest rates go up, so long as it's gradual and it doesn't point to overdoing it in terms of the Fed's efforts to cool down the economy or cool down inflation. And I think this story right there has a lot of implications for what's going on right now. We raised the interest rates 2 days ago by 75 basis points. And since March, we've had 225 basis points of rate hikes. That's similar to that period we just talked about, 2015 to 2018. That was 200 basis points. But now there's signs that the Fed will slow down the size or reduce the size of future rate hikes as they await more economic data and make sure that we get a grip on inflation over the longer haul. So yes, interest rates can continue to go up, but the monthly charts of the S&P 500 and other indexes show that stocks can also trend higher. So that's just one, I think, lesson that we can learn. At the same time, look at that big steep curve from the basically the spring of 2020 until now. That big jump in the price of interest rates really pummeled stocks. We can never say that will never happen again. And if you see that happen, then you should be prepared for some kind of reaction on Wall Street.
So do you think where we're at now with the Fed rate hike cycle, how much of that is priced in at this point? Is it going to be a concern with future Fed meetings that we have on the table later this year? Do you think the worst is behind us? Can investors breathe a sigh of relief now? How should we be thinking about this equation as the year progresses?
I would definitely breathe a sigh of relief, but still be cautiously optimistic. I wouldn't be going full bore, individually with my own portfolio, just because we've had two strong up weeks in the market. We still have to watch for upcoming economic data that shows that hopefully because of easings of the supply chain channel and the possibility that fuel prices will come down, that it will paint a more bullish scenario in terms of inflation, the economy, and therefore stocks. So we always take it day by day, week by week, right? And just leave all the possibilities out on the table. But, for now, I think at IBD, we feel more optimistic about the stock market's prospects going forward in the next 6-12 months than any time this year.
Well, that's great to hear. And I think that's actually a great segue to our next topic, which we'll get through quickly because you, sir, it's Friday print production day. So we got to get you out and over to checking all the pages and all the data. But so really quickly, so now that we are armed with this data and open to the different possibilities that could happen, I think having those different scenarios planned out in your head can help you deal with the potential fear when you do see a big shift in the market, because there have been a lot of negative headlines this year, not only with rising interest rates, but inflation, as you mentioned, global concerns and issues that we are dealing with, and of course the bear market. So dipping our toes back in the water after maybe having a tough year, getting dinged here and there or taking big losses, it can be kind of scary to know, hey, is this the right time, or am I gonna get tricked again just when I think things are going great? The market's gonna get slammed again, and the fear of that happening.
True. And believe me, we all take our lumps in the market, especially when we stick our neck out during tough corrections like what we've just experienced over the past 8 months. But I think it's important that in order to capture some really strong gains in the future, you have to dust yourself off. You have to be willing to see the market objectively now and identify and recognize new opportunities in the form of strong stocks showing good action, forming what we like to call bases or bullish chart patterns and breaking out. And one way to sort of hopefully put a muzzle on that fear of being taken to the cleaners again would be something like, one thing I like to look at is the new highs versus new lows on a daily basis. And these past 2 days showed really nice numbers in terms of more NASDAQ and NYSE stocks hitting new highs versus new lows. On Thursday, for instance, we saw the leading sectors within the new highs: business services, medical, and consumer. That's different from all of those oil and gas stocks that led much of last year. When you are thinking about buying a stock or trying to reinvest, it's the same as when you're trying to, get back into the swimming pool, most of us would rather just put your foot in, test the waters, see if it's comfortable, and slowly get in and enjoy the water instead of just plunging in like a cannonball. I mean, maybe Allie, you and I did that when we were real kids, and that
Yeah.
was not a problem. But when it comes to your hard-earned money and your portfolio, just take it one step at a time. There's no need to go fully invested from 0 to 6th gear in just a day or two.
Right.
Let the market prove that new buys are working. So that's one thing to do. But it's also very important to at least invest in one ETF or one stock and get the feedback from that stock. So that's really important.
Absolutely. And you knew IBD founder Bill O'Neill for many years working at IBD, and he also has some words of wisdom for any scenario for investors, of course. But what would be his words of wisdom at this time?
Well, I actually want to highlight a memo that he wrote to his institutional clients that was published in this book that he wrote not long after the tech bubble crash of 2000 to 2002, the successful investor. And right after we had a follow-through day on March 17th, 2003, it's interesting that he said, over the previous 21 days, we observed what we believe to be a bottom building process in that 13 days of accumulation occurred in the NASDAQ, the defacting leading index, as it was in the process of moving toward its recent low. This was on page 161. It's just a 2-page memo he sent all of these institutional clients, and it included the point that the move from January to early March of 2003 represented a third wave of selling after the market made a nice interim rally from the October 2002 low up until December of that year. So the point being, yes, it can be really rough markets even as the stock market is bottoming out. But the key point here was that he identified multiple days of strong gains in the markets, in the equity indexes, and in big volume or higher volume. That's what we call accumulation. You want to see that in the stocks that you're interested in too, and you want to see evidence of that happen day after day after day after day. So once again, 21 days he observed 13 days worth of accumulation, 13 days out of 21 trading sessions. That's what we're hopefully going to see in the next several days and weeks, since the June 24th follow-through day by the NASDAQ, which was obviously less than, about 5 weeks ago. So, if this rally continues, we're going to see more evidence of accumulation. We're not going to see lower lows. We're going to see higher lows on the indexes, and then more breakouts, more new highs, more non-energy sectors also participate.
Right. And here's a visual look on a monthly chart of the NASDAQ of that 0203 market bottom and rally. And that is such a great memo to be leaning on from Bill. Great reminder of what we should be looking for in the current market. And before you go, Dave, let's also check in on one stock that you've been keeping tabs on, but you keep tabs on a lot of stocks. You're a busy guy. I mean, deputy markets editor, IBD Live host, leaderboard portfolio manager. But let's
co-manager.
Yes, of course, co-manager. But let's take a look at Cadence Design Systems for the month, Dave. I didn't even look at this on a monthly yet in terms of the percentage gain, up 24% this month here. Going to a weekly chart, a strong week, up 11%. So it looks like, at least for now, all systems go with this software long-term leader.
Kind of rare right now, Allie, to see software stocks showing some real gusto. And this is one of the few right now. But we actually highlighted this in the long-term leaders column. That's part of the stock list section on investors.com. And the long-term leaders list has shrunk a lot over the past 7-8 months, but Cadence Design survived, It's in electronics design, and it's got an incredible product. You can see that the quarterly growth in sales and earnings are what we're looking for. And so with long-term leaders, we hope to identify the entry points just as they clear their 40-week moving average, which is that black moving average line on the weekly chart there. And so fortunately, after last week, we noticed, wow, this one's perking up. Monday looked really good. So we wrote about that and highlighted that. Some other names that are included in that feature in long-term leaders are stocks like KLAC, and we're watching closely Fortinet, FTNT. FTNT is not yet triggering sort of a long-term leader style entry, but it's trying to join the leadership. So, at least from that vantage point, tech seems to be repairing itself, and hopefully we'll participate more in coming rallies.
We'll have to see. Well, Dave, thank you so much for your words of encouragement. And we love how you're explaining things in a way that just really help things make sense to investors that can sometimes be complex or complicated, but you really distill it very eloquently. And it's always great to hear your perspective and to hear that, with you being such a glass half full kind of guy, seems like that glass is filling up even more in
A little bit
the last
by little
week,
bit. I
a little bit by
appreciate that
little.
comment, Allie. Yes, and uh, in closing, I would say even Bill O'Neill said he never met a successful pessimist, and we have featured some short selling ideas here and there, but really the majority of returns for most people are going to be on the long side. So always keep your eyes open for those opportunities and keep an open mind.
Great words to end on. Thank you so much, Dave. And thanks everyone for tuning in to this week's Trader Tales with IBD. Hope you have a great weekend and see you back here next week.